The US stock market has rebounded approximately 17% from the low on April 7th, which was triggered by the escalating tension between US and China trade war. The recovery has been steady, driven by positive developments such as announcement of US-UK trade deal and more significantly a pause in the US-China trade conflict. However, the most prominent emerging risk right now facing the US stock market is the potential for a trade war with European Union, which would deliver a significant shock if it escalates. On Friday, May 23rd, Trump threatened to impose a 50% tariff on European Union, accusing the bloc of dragging out negotiation and unfairly targeting US companies with lawsuits and regulations. Essentially, Trump is using his Euro pain tactic, pretty much applying economic pressure to force a country or a institution to negotiate. So he is using this. He used this approach with China a month ago, and now is applying it to European Union. When the trade war broke out in April 2025 between US and China, the market was so feared. $5 trillion were wiped out from the US stock market because people were scared of the inflation surge due to America's heavy reliance on Chinese imports. If a similar trade war erupts between US and European Union, the economic impact could be just as severe, if not worse. Because if you look at the chart, this chart shows you the top US trading partner in goods for 2024. Okay, not services, only goods. So the orange represents import to the US, and blue represents exports from the US. So in 2024, US actually imported more from EU, which consists of 27 countries, than from China. Right? So in 2024, US imported $606 billion worth of goods from EU, compared to $439 billion from China. And with pharmaceuticals were the largest US-produced product exported to US in 2024, totaling $127 billion. So many US pharmaceutical companies actually operate in Ireland due to the low tax rate. So they can actually cut the production cost lower if they manufacture in Ireland than manufacturing in US. So other major imports from Europe, including cars, automobiles, and trucks, about $45.2 billion in value, and various types of machineries, especially the high-end machineries that makes the semiconductor chips. So if US and EU enters a spiral trade war where both sides keeps on escalating until they basically effectively decouples. Similarly to what happened between US and China a month ago, American consumer will face higher costs, especially in healthcare. So US healthcare costs would surge due to the heavy reliance on European imported healthcare product. And also consumers will facing higher costs for European cars, wines, and luxury goods. But however, the US-EU trade war, while damaging, would likely to be less disruptive than the US-China decoupling. This is because most EU imports are high-value goods in comparison to the Chinese imports are low to mid-tier mass consumer product that would significantly impact CPI right away. Okay, so many EU imports are non-discretionary, excluding pharmaceuticals and high-end machinery. Those two are staples. But the rest are discretionary. For instance, the European cars, wines, luxury goods, they're non-essential. American consumers have plenty of alternatives to buy from other countries. Of course, US have a trade surplus in services with European Union, and European Union has previously threatened to take action against US services exports. Because the services is not targeted by the tariff. Tariff only look at the goods. So if they do target US services, it will hurt some of the American companies that provide services to European Union. For example, Microsoft, Alphabet, or Google, and JP Morgan. However, I think this is more like a mid to long-term issue, and it wouldn't cause a immediate pain. And in reality, it's actually not a strong point of leverage for EU, because even the US have a services trade surplus, but US only have a $67 billion services trade surplus with EU in 2024. So on this chart, these bars on the top are the US services export to EU, and these are the services imports from EU. The black dots are the trade balance between the two sides. So the surplus is not huge, right? $76 billion. And in conclusion, if the US and EU engages in a trade war that escalates to a full decoupling, similar to the severity that happened recently between US and China, it would pose a significant threat to today's stock market, causing turbulence, sell-offs, but I don't think the impact will be as substantial as the one we had between US and China trade war, where like 2 days you have the stock market evaporating $5 trillion, you have the VIX fear index jumping all the way up to 60. I don't think that's going to happen again. The EU is actually currently in a particularly uncomfortable position heading into this potential trade war with US, because it's already under pressure from China, the Chinese EV manufacturers. Since 2020, Chinese EV export to to Europe has surged. By June of 2024, right? Chinese EV brands has captured 11.1% of the Europeans' total EV market share. This actually posed a serious challenge to the European local car makers. So I believe this actually led to additional tariff on Chinese EV imposed by EU, announced in October, just 2 months after the peak, right? In October 2024. And since those tariffs were applied on Chinese EV, the market share of Chinese EV dropped to like 4.9% by February of 2025. So the protectionism is working for the pure EV sector. But unfortunately, the effort to protect local car makers hasn't been working very well, because the additional tariff only applies to pure Chinese EV, not the ICE car, the internal combustion engine cars, the hybrid cars, the plug-in hybrid vehicles. So as a result, China shifted its focus to export those non-tariffed vehicles to Europe, causing a surge. Look at this surge, right? For the non-tariffed vehicle types, surge in the European exports. And the surge actually filled the gaps that were created by the weaker pure EV export. So in March of 2025, Chinese car brands reached 5.2% market share in Europe, right? And this is the dent created by the tariff in October 2024 on the pure EV, right? So it didn't do much to the Chinese car manufacturers. And in March 2025, there are 73.6 thousand Chinese cars registered that month. And this surge shows that the European Union's attempt to protect the local car makers has been failing. Okay, despite the tariff on the pure EV, the overall strategy is not working. In 2024, European Union exported 38.9 billion euro worth of cars to the United States, making US its largest automobile export market. Exports to China was 14.5 billion euro, making China the third largest market, right after UK. So if US and EU enters a trade war, a decoupling, it would severely impact European car manufacturers, especially with rising competition with the Chinese EV makers. So a decoupling would be catastrophic for those car makers and putting the industry in a highly vulnerable position. Germany, being the largest economy of the European Union, accounted for over 50% of the total EU's automobile export in 2024. The country will be hit the hardest. So the car industry is actually currently one of the most vulnerable pain points for European Union. So even though the potential US and EU trade war is the most significant short-term risk for US stock market, there are several near-term development which could be positive. So Treasury Secretary Scott Bessent mentioned that multiple major trade deals would be announcing in the upcoming weeks. He also expected another in-person meeting between Trump's administration and Chinese officials in the near future. And additionally, Japanese chief trade negotiator also expressed hope that a resolved tariff discussion will happen ahead of the June 15th to 17th G7 meeting between Trump and the Japanese leader. Hopefully the progress will be made by then, and those good news, the upcoming good news, will potentially help counterbalance some of the negativities caused by a potential US and EU trade war. Thank you very much. Please like and subscribe.